Today, we're talking about one of the most expensive parts of DSCR loans, which are prepayment penalties. And whether you're a seasoned investor or just closing your first rental property, these penalties can make or break your deal. So, stick around. I'm going to show you how to avoid the traps and even use them to your advantage. Before we dive in, let me show you exactly what we're going to learn in this video. We're going to start with the state-by-state specific rules because depending on where you buy, prepayment penalties might be completely banned, limited, or wide open. Knowing this can save you thousands of dollars before you even apply. Next, what we're going to do is we're going to cover the most common types of prepayment penalties that lenders use so you can spot the traps and understand what you're really signing up for. Then we'll break down how these penalties directly affect the interest rate. And spoiler alert, the penalty you choose can actually cost you or save you thousands up front. I'm going to show you how you can protect yourself from getting blindsided by lender fine print and how to spot red flags before you sign. And then we're just going to finish with strategies on how to get the best DSCR rate possible. And I'll share my $1,000 personal lowest rate guarantee so you know you're getting the best deal in the market. So stick with me because each of these points builds on the last, and by the end, you'll know more than most investors out there. In Iowa, Kansas, Minnesota, and New Mexico, prepayment penalties are completely banned, so lenders cannot offer you any prepayment penalty, which means that these can most likely be a little bit more costly because they have to charge you the fees that they normally would charge if you want a no prepayment penalty loan. Now let's look at the states that don't outright ban prepayment penalties, but they do put limits and restrictions on them. Take Arkansas, for example. They'll let lenders impose a penalty, but only for up to 3 years, and it usually is a step down of 3-2-1. In DC, it's capped even tighter, no more than 3 years, and the most you'll ever pay is 2 months of interest. Georgia is stricter, only allowing for the first 2 years 2% if you refinance or sell in year 1 and just 1% in year 2. After that, you're free. Hawaii puts a flat ceiling on it, 6 months of interest max. Illinois, it gets a little bit trickier. If you're borrowing in your own name, penalties are flat out prohibited, but if you close in an LLC or corporation, then they can still apply. Here's the big takeaway. If you're investing in one of these states, you can't assume penalties are the same across the board. Each one has its own quirks, and missing that detail could cost you thousands when it's time to sell or refinance. Now, I'm not going to bore you by going through each one of these, but as you can see, there is a lot to navigate state to state. If you would like a full list breakdown, in the description of this video is a link to my site that will tell you each state's rules so you can verify wherever you're planning to invest. In all other states that aren't listed, you can just assume that prepayment penalties are allowed, and most lenders are going from 1 year to 5 years. So why should you care about all these rules and penalty structures? Let me break it down. If you're buying in a restricted state, you need to know the fine print before you close. Nothing's worse than finding out at the closing table that your lender can't even give you the terms you expected. If you're in a state with no restrictions, don't get comfortable because now your lender's programs are in full control. One lender might lock you into a 5-year step down, while another might give you flexibility and slightly higher costs. Knowing the difference can save you thousands, and here's the biggest factor for your exit strategy. If you're holding long term, penalties might not affect you, but if you plan to refinance or sell in just a couple of years, the wrong penalty structure could eat into your profit. Imagine selling a rental after 18 months and handing over $10,000 in penalties. That's real money out of your pocket. This is why smart investors don't just look at rates, they look at the entire penalty structure and line it up with their investment timeline. All right, let's go over the 3 most common prepayment penalty structures you'll run into with DSCR loans. First is up to 6 months of interest. Sounds simple, but it can be a killer. If you pay off a loan early, the lender charges you 6 full months of interest on the balance. On a $400,000 loan at 7%, that's around $14,000 just for exiting early. Next is a flat 5%. This one's straightforward but painful. No matter when you sell or refinance, you'll owe 5% of the loan balance. On that same $400,000 loan, that's a $20,000 penalty, even if you exit year 4. And then there's the step down penalty. This is the most common structure you'll see. It starts high and gets lower each year. So a 5-4-3-2-1 structure means if you sell or refinance in year 1, you'll pay 5%. In year 2, it drops to 4%, then 3%, and so on until it disappears after 5 years. This is where most investors get tripped up. What looks like a small percentage can actually equal tens of thousands of dollars depending on your exit strategy. Now, this slide is an example of how prepayment penalties impact the cost of the rate for the same exact rate. Think of it as the trade-off between flexibility and upfront costs. So let's break this down. If you want no prepayment penalty at all, you're going to pay for that flexibility. On average, it adds up to about 1.75 points to your cost. On a $400,000 loan, that's roughly $7,000 up front just to keep your exit strategy open. Now, 1 year prepayment penalty lowers the cost to about 1.125 points or $4,500 on that same $400,000 loan. With a 2 year penalty, the cost drops again, only a half a point. That's about $2,000 up front. A 3 year penalty is the tipping point. At this level, there's no added cost at all. You're essentially getting the rate at par. Now, here's where it gets interesting. If you go and agree to a 4 year penalty, the lender actually gives you a credit back of about a half a point. So that's $2,000 in your pocket to be able to use for other closing costs. And with a 5 year penalty, the credit even gets bigger, about 0.875 or 3,500 credited back to you. So here's the takeaway. The shorter the penalty, the more you pay up front. The longer you commit, the more you save on closing costs, sometimes even getting paid by the lender. But it all comes down to your plan. If you know you'll refinance in 2 years, don't lock yourself into a 5 year penalty just to save a few $1,000s up front. This is why understanding prepayment penalties isn't just about exit strategy, it's about rate and cost structure right now. So let's put this into a real world example so you can see exactly how prepayment penalties change the numbers. Here's the setup. We're looking at a 30-year fixed purchase loan with a loan amount of $400,000, loan to value 80%, so the borrower is putting 20% down. The DSCR ratio is 1.25, meaning the rental income covers the payment with a 25% buffer, and the borrower is solid credit at 740, and this is for a single family long-term rental property. This is about as clean of a file as you'll find. Good credit, solid income coverage, and a safe LTV. Now here's the kicker. The interest rate the investor gets depends heavily on whether they take a 1 year prepayment penalty or a 5 year prepayment penalty. On the next slide, I'm going to break down the actual numbers side by side so you can see what the difference looks like in real dollars and cents. Now let's compare when you choose a 1 year prepayment penalty versus a 5 year penalty. The exact same $400,000 loan. If you take a 5 year penalty, your rate comes in at 6.875 with 0 discount points. That means no extra cost up front for the rate. But if you only want a 1 year penalty, you've got two options. You can still get the same 6.875, but you're going to have to pay 2 discount points, which is $8,000 at closing. Or you can avoid paying those points, but then your rate jumps to 7.25%. So what's happening here? It's flexibility costs money. If you want the option to exit after year 1, you're either paying $1,000 up front or you go ahead and go with a higher rate for the life of the loan. Meanwhile, if you are confident you'll hold the property for at least 5 years, you could lock in at a lower cost with no points at all. This is the trade-off every investor has to weigh. How much is short-term flexibility worth to you versus the savings of committing longer? This is where you protect yourself as an investor. Too many people get burned because they didn't ask the right questions up front. First, always ask, what is the prepayment penalty for this rate? Lenders may quote you a rate that looks great, but it might come with a 5 year penalty they never mentioned. Next, ask, can I make extra principal payments during the prepayment penalty period? Some lenders allow partial paydowns without triggering the penalty, others don't, and that detail matters. Third, show me the disclosures and where the penalty terms are written. If the lender can't point it out to you in writing, that's a red flag. And here's the part many investors miss. You may also get charged extra if you want to waive escrows for taxes and insurance, or if you're closing in an LLC. If you plan on doing either, ask up front so you're not surprised at closing. At the end of the day, the investor who asks better questions is the investor who saves thousands. Don't just shop rates, shop the fine print. Now, when it comes to choosing a lender for a DSCR loan, you really have 3 main options, but each comes with its pros and cons, so you need to know. First, local banks and credit unions, a lot of them don't even offer DSCR or non-QM loans because they're considered riskier. And if they do, expect stricter guidelines and tighter restrictions when it comes to them lending. Next is big online lenders. They love to advertise super low rates, but here's the catch. You're often working with a newer loan officer who doesn't specialize in DSCR loans. These companies can pay their loan officers less per loan, which means might not even get the expertise you need as an investor unless you're prepared to double check everything yourself, and this can cause problems down the road. Finally, you could work with a mortgage broker. The advantage here is the flexibility. A broker can shop multiple lenders to find the best rate, lowest fees, and the program that actually fits your scenario. But remember, not all brokers are created equal. You want one with experience in funding DSCR loans, not just someone dabbling in them. So the key is, don't just pick a lender type, pick the right partner who knows this space and can guide you through it. When you're choosing a lender for a DSCR loan, it's not just about the rate on paper, it's about who you're trusting as a partner in your investments. So start with these basics. What do their online reviews and reputation look like? That tells you a lot about how they treat their clients. Then dig deeper. Do they start with a soft credit check so they don't take unnecessary hits? Do they offer a consultation first to understand your goals, or do they push you straight into an application just to lock you in? Ask if they'll do a rapid rescore to help improve your credit quickly. How fast can they realistically close a deal? And here's a big one. Will they call the listing agent to strengthen your offer, or are they just hiding behind an email? And think about their availability. Are they working 9 to 5 Monday through Friday, or will they pick up the phone on the weekend when you're making an offer? But here's the next level. Will they act as your second set of eyes on the deal itself? Have they invested themselves so they understand what makes a property a good or bad investment? And most importantly, are they willing to tell you to walk away if it's a bad deal, or are they just chasing a commission? A great lender isn't just a rate shop, they're a partner who helps you build wealth and protects you from mistakes. Let's talk about some of the most common mistakes investors make when choosing a lender. And trust me, I've seen all of these firsthand. Mistake number one, failing to shop or interview multiple lenders. Too many investors just take the first offer they hear. That's like buying the first property you see without running comps. You'd never do that, right? Mistake number two, just working with your real estate agent's preferred lender. Now, sometimes that works out, but often it doesn't. Remember, your agent's priority is closing the deal. Your priority should be protecting your money. And mistake number three, relying on the internet. Online ads and flashy rate quotes don't tell the full story behind the scene. The fine print may include penalties, higher fees, or weaker service. And finally, mistake number four, not asking questions. This is the easiest way to get blindsided if you don't dig into the details, like prepayment penalties, escrow requirements, or closing costs. You could be signing a deal that eats away at your profits. Avoiding these mistakes doesn't take extra effort, just a little more awareness, and it can save you thousands. So here's a quick credibility check. Don't take my word for anything, verify it. These are my public reviews on Google and Zillow. You can read a few, skim the oldest and the newest, and look for patterns, communication, speed to close, my expertise on DSCR loans, and how problems are handled. And don't stop with me. Do the same due diligence on any lender you're considering. You can Google their name plus reviews. You can check the NMLS where we're all licensed. You can ask for two investor references and actually call them. Request a sample DSCR quote with the prepayment penalty terms circled and explained. Ask if the deal isn't great for me, will you tell me to walk? The right answer is yes. So, a little bit about me so you know who's behind all this information. My name is Trevor Gravink, and I've personally funded over 400 loans representing more than 80 million in volume. And that's not theory, that's real investors and homeowners I've helped across the finish line. I consistently rank in the top 1% of brokers nationwide, which means I'm not just closing deals, I'm closing a lot of them successfully. And that matters because expertise is everything when it comes to spotting red flags, structuring DSCR loans, and making sure your file doesn't fall apart during underwriting. But here's what's more important. I built my business on repeat clients and referrals, not quick commissions. That's why I spend the time to educate you on things like prepayment penalties so you don't just get a loan, you get the right loan for your strategy. So when I talk about protecting your bottom line, it's not theory, it's what I do every single day for investors like you. I want to end with something that sets me apart, and it's my $1,000 lowest rate guarantee. And here's how it works. If you close a loan with any lender for a better overall deal that I can give you, meaning a lower combination of interest rate, fees, and prepayment penalty, I'll cut you a check for $1,000. Why do I offer this? Simple. I know the DSCR market inside and out. I shop dozens of lenders, and I already run lean on margins. That allows me to consistently deliver some of the lowest total cost options in the industry. So if you're serious about your next investment property, let me run the numbers. Worst case, you walk away with confidence knowing you got the best deal. Best case, I'll save you thousands. And if I don't, I'll literally pay you for proving me wrong. Now, we've covered a lot from state to state specific rules to how prepayment penalties affect your interest rate and even the questions you should be asking every lender. Now it's time to apply it to your deal. Every investor's situation is different, and the right structure could save you thousands. So here's how we can connect. You can text me or call me directly at 619-404-6637. You can shoot me an email at trevor@rebrokerbuddy.com, or just scan the QR code on the screen and schedule a one-on-one call with me. Whether you've gotten an active deal you want priced out, or you just want to explore your options, my job is to make sure you don't get a loan, you get the right loan for your investment strategy. So don't wait until closing day to find out you signed up for the wrong structure. Reach out, let's talk through your DSCR deal. I can be your second pair of eyes if you're already out there shopping. And if you learned something from this video and you want to learn more about DSCR loans, please subscribe to my channel and share it with other investors that you know in your groups.